ICICI Lombard, Harsh did catch up with the management, which is Gopal Balachandran, Chief Financial Officer. Let's listen into what he had to say on earnings.
So let me first start off by understanding how the pricing environment is evolving, both in terms of health as well as motor, which is obviously the two largest segments that you have. So give us that perspective to start off.
So good morning to you and good morning to all your viewers.
Good morning, sir.
I think, so let me again just put this in context. I think if you look at the market currently is running at a combined ratio of about 112%, which is to say that against 100 rupees of premiums that you're collecting, all of your obligations or outflows put together, the industry is kind of losing roughly anywhere between 12 to 13%. So obviously, in that sense, when you look at it, the market has to get far more disciplined insofar as the pricing environment is concerned at an aggregate level. Now, let's break it into specific segments. To your point on what's happening on motor, what's happening on health. Let's take motor first. Now, while I gave the industry combined ratios at an aggregate level, if you were to look at motor as a category, industry is actually kind of slightly more worse off because as we speak, for the last year ended gone by, the industry actually reported a combined ratio of 124%. So this is obviously is in that sense quite significant insofar as underwriting losses are concerned. And in the backdrop is where I think again the industry has to kind of course correct itself insofar as the pricing environment is concerned. So hence, as we speak, the market continues to remain aggressive. And that's the reason why we believe at that 124% levels of combined, it cannot be sustainable. So players have to kind of improve pricing in general. And within that, in the current year specifically, there is also a regulatory stipulation for companies which are exceeding the expense of management threshold to come within the limits that are laid down. So hence, there is also an expectation that the pricing environment should get better as we kind of head into particularly the second half of the year, largely to kind of meet compliance with guidelines. And the last part that I would say in the context of motor in the with respect to the pricing regime is, I think clearly there is a equal seek insofar as increase in price for motor third party. When that will get happen, very difficult to kind of comment. But honestly, as an industry, we have sought a increase in pricing for motor third party. To your point on health, I think as ICICI Lombard, I think we have always kind of maintained that on an annualized basis, we are okay to run the book at a loss ratio in the range of 65 to 70%. And if you'd have seen for the year gone by, that number stood at roughly about 68% or thereabout. Within quarters, obviously there will be, let's say, reflection of loss ratios, which could be plus minus within that range. But at a company level, from an ICICI Lombard standpoint, I think the range that we are comfortable operating at is between 65 to 70%. And there, I think we are quite comfortable insofar as price is concerned, particularly in the context of ICICI Lombard.
Point taken, sir. Sir, so when does growth start to kick in? Given all of this, what is your current viewpoint? What's the pulse feeling like?
Look at quarter one gone by, right? I think even if you look at, so there is obviously this element of 1 by N. If you recollect, I think we did speak about even in last quarter. This was a regulatory change that had happened in October of 2024, which is likely to kind of subsist for one more quarter, as in for quarter two. We did see the impact of it in Q1 as well. But leave that aside. Even keeping that aside, the industry has kind of grown at roughly at about 8.8%, which I would say is reasonable insofar as given where we are in terms of the overall scheme of things. But if you were to break down in terms of categories, most of the segments have grown almost at similar levels, particularly when you look at motor and health at an industry level. And commercial lines, if you recollect, last year did see stress in pricing. Now that's come back, which is a good news. And therefore, the expectation is pretty much similar, I think, as what we have maintained. I think the second half of the year will obviously be out of the 1 by N prescription. So hence, to that extent, one should logically start seeing normalized growth coming in. If you look at the long-term averages, I would continue to say that general insurance industry should continue to exhibit growth in that range of 15 to 20% from a structurally long-term perspective. In this year, I think there are both headwinds and tailwinds, and therefore, to that extent, it will be reasonable to expect the industry to grow in a high single digit to maybe early double digit numbers.
Okay, high single, early double. What should we expect on the combined, sir? Because the combined doesn't, or rather, there seems to be some amount of difficulty in it coming off. As pricing likely improves, can the combined improve, and by how much by end of this year?
Yeah, that's always a difficult question to answer, right? But having
Yes,
said
yes,
that,
absolutely. I don't envy you, sir, but
yeah,
but
yeah.
yes.
So, but having said that, again, let's look at how ICICI Lombard has kind of put out their numbers for quarter one. Again, I would just kind of give the numbers because what gets reported on a published basis may not be comparable with the Q1 numbers last year. Again, for the same prescription of the N and the 1 by N related impact. And I will confine myself right now on a like-to-like basis, which is on an end-to-end basis for Q1 last year and Q1 current year. Q1 last year on an N basis, we reported a combined of 102.3%. If you'd have seen the numbers for ICICI Lombard for Q1 this year, which is for Q1 FY26, again on a like-to-like basis on an N basis, that number stands at 102.2. So actually, we have been able to make a moderate improvement in the overall combined numbers. However, what gets published is more on a 1 by N basis, where the number stands at about 102.9. So directionally, again, as I said, on a like-to-like basis, we have been able to make an improvement in the combined ratios, and exactly to the point that you originally asked, as in terms of how the pricing environment is playing out. As the industry starts to kind of respond well in terms of improved pricing regime and also overall growth getting stimulated, logically we should be able to kind of further see an improvement in our combined by the end of the year, and that is exactly what ICICI Lombard has been exhibiting pretty much every year since the last 3 years in terms of improvement in combined.
So this very strong investment income, that's largely led to the profit beat. And I know maybe you can't talk about the beat in profitability, but that is how the analyst community views it, right? So can that sustain? Where is that coming from? Give us that color.
Yeah, so again, I think I'll put this in context. I think from an ICICI Lombard standpoint, I think the good news is I think a large part of our business is significantly granular and retail. Now that ensures that as a company, we are able to have regular streams of cash flows, which kind of takes care of the obligations that we may have on a day-to-day basis. And therefore, from an investment standpoint, I think general insurance is a business of float, because the beauty of the business is you get money on day one, and till the time the various obligations doesn't get paid out, you are able to kind of make that investments in the right calls.